If you had to pay rent, your credit card, and every other bill right now, how long would your account survive? It's 2:11 a.m. You're in bed, quietly opening your banking app. Not because you bought something fun, because rent is due in 2 days, and the words "payment due" on your credit card keep flashing in your head. The thing squeezing your chest isn't the total debt. It's the minimum payment small enough to look harmless, but big enough to keep you awake. Credit card interest in the US has been hovering around about 20% a year, often higher. And after inflation spiked to 9.1% in 2022, a lot of life got more expensive even when you didn't change anything. Most people aren't living by a money plan. We're living by one rule. If you can make the monthly payment, it's affordable. Student loans, car notes, buy now, pay later. This story is about why that rule is everywhere and how it breaks you slowly, month by month. Hi, I'm Dax. Welcome to Dax Invests, where we share personal finance through a science-backed lens so you can make calmer, clearer money decisions. If you feel financially stuck and you can't even explain why, this video is for you. I'm not selling a get-rich story. I just want you to see the mechanism that quietly pulls you down each month. We'll start with small everyday stuff. Rent, credit cards, monthly payments. Then we'll zoom out to 5 pressure gauges that shape your life whether you watch them or not. Interest rates, inflation, exchange rates, housing prices, and liquidity. They sound big, but they land directly in your wallet. When inflation hit 9.1% in 2022, normal got more expensive overnight. And when the Fed's overnight rate moves, it nudges the whole cost of borrowing up or down. When you live by "I can afford the monthly," you don't see the rope, you just see the due dates. The warning signs usually aren't loud. They're normal. You start automating everything. Auto-pay rent, auto-pay cards, auto-pay loans. For a while it feels like relief, less thinking, less stress. Until one week you get fewer hours. Or your car breaks. Or you get sick. And the payment schedule doesn't care that you're tired. In the US, life is priced in monthly slices. Recent typical rent numbers have hovered around $2,007. 30-year mortgage rates have been around 6% in mid-January 2026. And a 48-month loan on a new car has been around the mid-7% range. Even buy now, pay later shows up like a friendly button because it makes the same item look cheaper per week. Regulators have noted how fast that market expanded from 2019 to 2023. The scary part is how normal it all feels until it doesn't. This is where the rule reveals itself. If you can make the monthly payment, you give yourself permission to add another monthly payment. It doesn't feel like being irresponsible. It feels like being a grown-up. But the trap is structural. You're turning your future into a stack of fixed costs. The more fixed costs you lock in, the more fragile your life becomes when anything slips. And it's not just you. U.S. household debt has climbed to about $18.59 trillion. Q3 2025. Credit card balances around $1.23 trillion. Auto loans around $1.66 trillion. Student loans around $1.65 trillion. When student loan payments resumed, the stress didn't show up as a headline in your life. It showed up as tighter months, more late fees, more "I'll catch up next paycheck." Some reports have pointed to sharp increases in serious delinquency transitions. The rule doesn't break you in one dramatic moment. It breaks you through accumulation. Let's talk interest rates in the simplest way. Interest is the price of time. When rates rise, borrowing gets more expensive. And some debts, like credit cards, are especially sensitive because APR is high and interest compounds fast. Making the minimum payment isn't a moral failure, it's a temporary bridge. The problem is getting stuck on that bridge for too long. Around mid-January 2026, the Fed's effective overnight rate has been around 3.64%. That number isn't what you pay directly, but it's a foundation that influences how lenders price many kinds of loans. So, "I can make it this month" doesn't mean "I'm fine this year." It only means your life is still working under today's conditions. And conditions change. Inflation does something quietly brutal. It turns standing still into falling behind. In 2022, CPI inflation hit 9.1% year over year. You felt it when groceries and basics got more expensive, while your paycheck didn't jump at the same speed. There is good news sometimes. Real hourly earnings, after inflation, have shown periods of growth about plus 1.1% from DEC 2024 to DEC 2025. But up doesn't automatically mean easy, especially when housing is still heavy. Home prices have felt like a door slowly closing. The National Case-Shiller Index has been around 328 Oct 2025, reflecting a high price level compared to earlier years. And when high prices pair with high mortgage rates, the monthly payment becomes a real gate. This is how the monthly payment rule becomes dangerous. It hides the long-term cost inside today's required minimum. When people hear crisis, they picture stock charts. But the core problem is often simpler. Liquidity. Liquidity means having cash at the exact moment you need to pay. Like having a decent paycheck overall, but not having enough in checking to cover rent tomorrow. Banks can have the same issue. Countries can have the same issue. In the US system, the Fed has tools to add or drain liquidity. Repo, reverse repo, the discount window, even flows tied to the Treasury can change liquidity conditions fast. And then there's CDS. Think of it like insurance on a bond's risk of default. When CDS prices rise, the market is basically saying, I'm less confident you'll pay. Add an exchange rate shock, where a currency moves sharply, and import costs, foreign currency debt, and financial stress can change meaning in weeks. That's the macro version of your personal life. You can be fine until you can't roll the next payment. If you want to see the pattern more clearly, look outside the US for a moment. The 1997 Asian financial crisis didn't begin with everyday people spending too much. It escalated when confidence flipped, money rushed out, and countries struggled with short-term foreign currency debt while the system ran short on liquidity. When exchange rates came under attack, we can pay today stopped meaning we can pay next week. The IMF describes how, in late 1997 and early 1998, it participated in major support packages for the hardest-hit countries like Indonesia, Korea, and Thailand, about $36 billion in IMF commitments within international packages, near $100 billion. In everyday language, it's the national version of the monthly payment rule. Refinancing works until the day nobody wants to refinance you. Greece and Argentina show two different ways the same structure can crack: debt stress and currency stress. In Greece, 2010, once markets questioned the government's ability to repay, borrowing costs surged, pressure spread through banks, and the story quickly became bailout or collapse. European Parliament materials noted Greek CDS levels approaching about 1,000 basis points in early May 2010, basically a loud alarm bell. Argentina is a long story of exchange rates and capital controls trying to hold stability while the currency and inflation keep pulling against it. The IMF has evaluations of the 2018-2021 program. And in more recent years, Argentina has continued changing its exchange rate approach, loosening controls to rebuild reserves and stabilize the system. The shared lesson isn't these places are bad. It's that when confidence drops, the ability to pay this month doesn't save a fragile structure. Turkey and Venezuela show more extreme versions of the same pressures: rates, currency, and trust. Turkey went through periods where policy choices put heavy pressure on the lira. The IMF noted that rate cuts in late 2021 increased pressure on the exchange rate. More recently, the story has swung back to very high rates. While inflation remains sensitive, reports have noted inflation falling from very high levels to around about 30.9% by late 2025, amid expectations of continued policy adjustments. Venezuela is a more extreme case. The IMF reported year-over-year inflation reaching hundreds of thousands of percent in 2018, around 488, 865%. The US is not Venezuela, but the physics of the system rhyme. When rates rise, liquidity tightens, and expectations flip, the monthly payment rule becomes more expensive faster than you can adapt. That's why we need to understand what the government and the Fed actually do in a crisis, and what you can do to survive without panic. In the US, crises rarely start with "everyone got reckless." They often start with one word: liquidity. When banks and markets don't trust each other enough to lend short-term, cash stops flowing. That clog eventually reaches you. Credit limits tighten, loan approvals slow, employers hesitate to hire, and even normal becomes harder to finance. Markets have a thermometer for fear: CDS insurance, style contracts on default risk. Higher CDS means people demand a bigger premium to feel safe. In that kind of moment, the Fed isn't only changing rates, it also acts as a lender of last resort through the discount window, so banks can access temporary cash instead of cutting credit to customers at the worst possible time. During COVID-19, the Fed opened multiple emergency liquidity channels under Section 13 to prevent money markets and credit from freezing. You don't feel those tools directly. You feel what happens when they aren't there. Here's the easy misunderstanding: the government and the Fed aren't saving your feelings. They're trying to keep the system from breaking so daily life can keep running. The Fed's most visible lever is the policy rate. Around mid-January 2026, the effective overnight rate has been around 3.64%. When it rises, borrowing gets harder. When it falls, pressure eases, but it's never free. The Fed also watches inflation. In DEC 2025, CPI-U was up about 2.7% year over year. Inflation is a quiet fee on your life. You didn't sign for it, but you still pay. Housing reacts through mortgage rates. Freddie Mac reported the average 30-year fixed mortgage around 6.06% on the 15th of January 2026. That number becomes roommates, rent renewals, and the feeling of working hard without catching up. Fiscal policy unemployment benefits, temporary supports, tax changes helps keep the lights on when the economy stumbles. Now let's bring the monthly payment rule back to a real 1824 story. You just graduated. You carry $5,000, $8,000 on a credit card from moving costs, a laptop, and a few months of not stable yet credit card interest. Commercial banks, all accounts, has been around 20.97% as of NOV 2025. You pay the 2%, 3% minimum. It feels like control, but most of your payment goes to interest, and the principal barely moves. Then you need a car to get to work. New car loan rates for 48 months have been around 7.53%, NOV 2025. That's another fixed monthly cost. And if you have student loans, you're not alone. The NY Fed reported about 9.4% of student loan balances in 90-plus days delinquent, or in default in Q3 2025. Household debt overall sat around $18.59 trillion. One small shock, fewer shifts, a medical bill, a rent increase, and the due dates start eating your breathing room. So what do you do when you're not rich, not stable yet, and real life keeps coming? Start with survival, not optimization. 3 layers. Layer 1. Personal liquidity. Enough cash so a surprise doesn't force you onto a credit card. If your cash is in a bank, understand that FDIC insurance has a standard limit of $250,000 per depositor, per insured bank, per ownership category. That doesn't make you wealthy. It helps you sleep. Layer 2. Lower your fixed costs. Not cut all joy, just keep rent, car, and subscriptions from swallowing your whole paycheck. The monthly payment rule is most dangerous after you've locked your life into too many required payments. Layer 3. Slow the growth of high-interest debt. If credit card debt is fire, minimum payments are a small cup of water. For student loans, know there are income-driven repayment options described on studentaid.gov. You don't need perfect. You just need the fire not to spread. If you want a replacement for, if I can pay monthly, it's fine. Try 3 slower questions. 1. If my income drops 20% for 3 months, can I still pay? This is a shock test. 2. Am I buying value or buying relief because the cost is split into smaller pieces? 3. After it's paid off, does this make my life cheaper or more expensive? That's not a hustle slogan. It's how you win back choice. And if you want less fog, watch 5 indicators, like weather, interest rates, EFF, inflation, CPI, exchange rate strength, abroad US, dollar index, housing prices, and risk signals like CDS and overall liquidity. For example, the broad US dollar index has been around 120.5856 on the 9th of January 2026. National Case-Shiller around 328.442 inches, OCC 2025. And the 30-year mortgage average around 6.06% on the 15th of January 2026. When that weather turns rough, the monthly payment rule gets more expensive before you're ready. Here's a truth that feels light but lands heavy. You can't control interest rates, inflation, or housing prices. You can't triple your income through willpower, and you don't need to, just to feel less afraid. What you can control is your structure. How much of your income is locked into fixed costs? How much liquidity you have to absorb a shock, and whether you're using high-interest debt to buy time or letting it buy your future. The rule, if I can pay monthly, I'm okay, doesn't usually crash you overnight. It drains you. It steals your ability to say no. It turns every decision into one question. Can I survive this month? If you feel stuck, you're not broken. You're living inside a system that prices everything by the month. On Dax Invests, we'll untie the knots: credit cards, student loans, car payments, rent versus ownership, and how to read economic signals without spiraling. If this video matched your reality, subscribe. Not for hype, not to get rich fast, just to feel calmer and more in control of your money, one decision at a time.